Welcome back to the Independent Investor Channel. This is super important videos. I'm going to be doing a review of the Roth IRA account number 2. This is the self-directed account. It's approaching $100,000, and the real question and takeaway for you guys is, does self-directed investing work? I've been able to triple 2 accounts here in the last 5 years, so very, very important to understand the actual wealth that's been generated in a very, very short amount of time. Realizing the power of a liberated dollar, and this is just indicative of the success that we're rendering as a self-directed investor, guys. So drop you into the account, please enjoy. All right, guys, I'd like to welcome everybody to the review of the Roth IRA account number 2. This is the second self-directed Roth IRA account that I own. This is for the missus. So we'll go ahead and conduct this review. I've built these 2 accounts to complement each other. You can really see here some of these positions in some real recessed conditions, and I think there's quite a cross current going on right now with the volatility in the stock market. I think there's a few names that are doing quite well, specifically the FANG names, and then you've got other companies that are very, very much lagging the total market, especially in energy, financials, the cyclicals as well. Industrials has really underperformed, at least the last month. We'd like to see a little bit more breadth to this recovery, but I just don't see that happening until we are able to get in the clear and get a little bit better clarity around this pandemic. So we're going to review the portfolio here, and not a lot of changes at all in this portfolio. There hasn't been any additions from what I can review here. But the top tech holding in this is Cisco Systems and Old Tech. Most of these are set up with a dividend growth strategy. So we're reinvesting our shares in these companies, and complemented by the passive ETFs as well. In this account, I've got 2 here. We did liquidate the small cap growth here, took some profit, was glad to do that, as I own small cap elsewhere, so kind of tailored back on my small cap exposure. Was an opportunity to put some cash to the side in this account, and we'll continue to own the Vanguard's S&P 500, almost back to even here, which is really awesome to see. After all that, to be down less than 1% in the S&P at this point in the year, with the total back half of the year coming up on us, and bought some recessed shares through the downturn, acquired some new shares in the S&P, and it's just doing its job passively. The second is the Vanguard's developed markets, which is basically Europe. So we do own 100 shares of that as well. So you can see those reinvested shares here are starting to add to that position. So those are the only 2 right now from a passive perspective in the portfolio. It's about 1/3, I guess, of the total overall value. Little over, I guess, 1/3 of the value. So fairly in line with where I want to be right now with the current state of the market, not knowing where things are going to go. The rest of the portfolio is made up of dividend growth companies. Corteva is the agricultural, and it gives me that exposure to the materials sector. Chevron here just has not been very fun to own energy. If you own energy, you're not making money. I don't see how it's been possible unless you've just picked up and got lucky on some of the smaller names. But owning big oil has just been a real drag. It's just been a terrible investment thus far. But we'll continue to own these shares in this portfolio, as you know, I do enjoy owning big oil, but it's just been a real drag over the last couple years. So we'll hope for better times there in big oil as that slowly starts to recover, and hopefully we can get a little bit of reprieve from what's been a pretty dismal sector thus far. DuPont, Chemours, and Dow, this was part of a 3-way spin-off of the original Dow DuPont. So DuPont Chemours here has been also a fairly good drag on the portfolio. Now again, when these split, these aren't real losses. This is just the assessed value of the newly formulated DuPont de Nemours, and same thing with Dow. So I've actually added a little bit to these positions to solidify them, get them up to about $1,400 each, and hold a little bit more respectable position, because these are the companies that give me my materials sector exposure, and we'll continue to own those long. I don't have a problem owning those in this portfolio. Honeywell, one of my favorite industrials right here, really done quite well for us. It'll be awesome to own this, easy company to own long term. Right below that, JP Morgan Chase and financials, and it's also been really drugged down. Energy and financials have really been the drag this year. Not the place to be if you're looking for hyper growth, which I'm not, to own these. I'm looking for sector exposure, best in breed. And from that perspective, you can absolutely justify owning a JP Morgan and a Chevron who's committed to the dividend. So I'm not looking for hyper growth out of these. I'm looking for dividend growth going forward, and these absolutely deliver on it. We just need to be patient on these names. It's not going to be gangbusters every day you invest in a stock. So this gives you some real insight on what to expect from single stock holdings and what it takes to go through some downturn in some of these, and realize that longer term goal of some of these single stock holdings. Kraft Heinz Foods here has done a pretty good job. It's actually starting to do well. As General Mills, I was down big in that position, and it's coming back to neutral. And I think this is a name to watch here going forward. I think Kraft Heinz and General Mills, a couple of old staples, are really showing some really good signs here. They both were beat down pretty good. None more than Kraft Heinz, as they had a little bit behind the scenes that they had to work through that was not favorable at all, and quite frankly unacceptable for a great company like Kraft Heinz. But we'll continue to own that, and nice dividend payer in the staples section. Right below is 3M. Like I had mentioned, I really thought that there was a breath of fresh air with industrials there for a short amount of time. But these cyclicals have really drawn back again as the pandemic has really shown itself, and we're really going to have to be patient with these names. Merck here was the dividend payer of the week. So this is a company with Pfizer that I want to own long, and I do own a partial position in Pfizer and a larger position on the outside of the Roth. So basically big pharma that we're owning here with Merck and Pfizer respectively, both Dow components, and just happy to own the stocks and sit on the dividend as it pays me month in and month out. Realty Income Core here, one of the bright spots in the portfolio. It really has come off as well from its high. It was really up there. I think I was up about 700, and normally I would render profits up that high, but I didn't. It would have been the right thing to do. Would have been to take some swing trading profit in that. But I didn't. You lose some and you win most, and that's fine. It's a win in either situation, and up 4 bits right here, owning the position less than a month. I'm happy with that too. Pepsi as well here, just one of my favorites in this portfolio. This is built around a consumer brand type of perspective. A lot of safe names in this portfolio. I've already mentioned Pfizer, Procter & Gamble being that in the staples sector, almost back to neutral. That'll be back to neutral by the year's end for sure. Hopefully it can start to perform a little bit. Verizon as well, or Visa, excuse me. Just an awesome tech company that I want to own, and off a little bit there as well. So it just going through kind of a bad time right now with the volatility, but I also want to roll these reviews out during times of volatility, so you can really kind of gauge the movement and the stock price movement in a lot of these names. Already talked about the passive aspect. We'll come down here to the final 3 of Verizon, telecom communications, nice large dividend payer we're off a touch there. Wells Fargo, already mentioned financials and the difficulty there, but continuing to get paid that dividend. And, we just need to work on this position a little bit and have that start to perform. Walmart right now is on fire. It's the hottest stock in this portfolio. And I think Walmart's probably going to grab some legs here. I think it's probably my top, one of my top picks anyway. Still a little bit expensive, but you always have to pay up for Walmart. But right here, I think is a pretty good entry. It's showing some real strength and resilience in this market as people are finding that Walmart's, one of those reliable companies that can remain open through this pandemic as we continue to let this thing hopefully pass. So with that, guys, we'll kick you back to YouTube and we'll conclude the video. Thank you so much.
All right, guys, so we've come back out of the review of the Roth IRA account number 2. I know my spouse is happy. This is her account, actually. We roll these reviews out periodically so you guys can understand the success of a self-directed investor. These are real results, real portfolio, going through some volatility right now, as indicated in some of the holdings right now. That's totally fine. I think the undercurrent and the real takeaway is to understand the power of the dividends being rendered off of this portfolio and the passive aspect getting us that rate of return every year that we're trying to achieve in this portfolio. Guys, if you enjoy the message coming through, you want to make sure and hit the subscribe button for us. Leave your comments at the bottom of the video and share the message with anybody out there that you know might appreciate the message and the focus on investing that we're putting through on the channel. Guys, thank you so much for tuning into the video, and good luck in your investment future.